Okay, let's dive right into this. Have you ever watched someone literally build their own financial apocalypse? Just brick by brick? Well, today in this explainer, we're unpacking a case study together that is painfully, uncomfortably real. We are conducting a full investigative autopsy on how a completely ordinary person can architect their own catastrophic downfall in the modern financial markets. You know, this isn't just some internet meme. It's a high-stakes, documentary-style look into what absolutely not to do when you start treating the stock market like a casino.
Our story usually begins with a question, and it's a very dangerous, stomach-dropping kind of question. Why is there suddenly $13,000 missing from our savings account? I want you to just picture that heavy, suffocating silence at the kitchen table, when a spouse discovers this exact dollar amount is just gone. In one single instant, the entire illusion of being this invincible hotshot internet trader is totally shattered by cold, hard domestic reality. So how exactly do we get to this terrifying kitchen table moment? To understand the downfall, we first need to understand our protagonist. Let's open up the case file on the timeline of Alex. So Alex has been trading in the markets for about 2 years now. And look, you might think 2 years sounds decent, right? But in Wall Street terms, 2 years of experience makes you the equivalent of a toddler discovering fire for the very first time. He's highly energetic, super enthusiastic, and just dangerously uncontrolled.
Tracing his path, we can clearly see this rapid, terrifying escalation. The absolute most dangerous moment in any beginner's journey is when they win purely by chance before they actually know what they're doing. For Alex, it happened in a single day. A lucky trade on a crypto meme coin bumped his portfolio up by 13%. That's it, just 13%. But man, that tiny, lucky gain planted the seeds for total destruction. Why? Because it instantly inflated his ego from clueless beginner to future hedge fund manager overnight.
And this brilliantly illustrates what happens next. Overconfidence behaves wildly in the real world. Suddenly, Alex is acting like he just watched The Wolf of Wall Street for the 5th time. He's spending his weekends at bars pitching highly speculative biotech penny stocks to complete strangers. He's firing off these intense, motivational trading tweets that get literally 0 likes. And he's double-packing Zion nicotine pouches like it's some kind of secret sauce to a visionary investment strategy. He genuinely believes he was born to be a full-time trading legend.
The root cause of this behavior comes down to something called the Dunning-Kruger effect. Alex is currently standing right at the absolute peak of Mount Stupidity. He's completely incapable of recognizing his own lack of skill. Essentially, he's confusing a lucky gust of wind with his own intrinsic ability to fly. In the psychology of investing, this is the single most destructive behavioral error that actively melts down portfolios.
Now, there is just a massive gap between traditional investors and today's modern trader. Traditional investors focus on boring things to calculate risk: cash flow, balance sheets, strict valuation metrics. But in the TikTok era of trading, people are treating the market exactly like a casino. They're buying coins named after dogs, frogs, and literal bodily functions and proudly calling it financial freedom. Honestly, if legendary investor Charlie Munger were forced to trade today, he'd take one look at Fartcoin and immediately retire a second time. We're in an era where momentary internet whims replace real value.
Let's move to how this builds into a disaster. Because while overconfidence drives you into a bad decision, a complete lack of risk management is the cliff you drive over. With this newly inflated ego, Alex exaggerates his net worth to his broker just to get approved for options trading, which, in inexperienced hands, are basically financial grenades with the pins pulled out. Within 3 months, he's fully leveraged into out-of-the-money Tesla options, and his grand strategy? Step 1, buy high. Step 2, sell higher. Step 3, hope. He has a highly dangerous, totally non-existent risk management protocol.
But here's the thing, you cannot rely on hope forever. Eventually, the macroeconomic reality check breaks the door right off its hinges. The Federal Reserve announces a rate hike, fundamentally shifting the entire market environment. Alex was swimming in incredibly dangerous waters, taking on massive risks he absolutely couldn't afford. Let me be incredibly clear here. Hope is never, ever a valid financial defense mechanism against a macro shift.
The speed of what happens next is just brutal. 67%. Gone. Almost instantly. Alex's portfolio immediately enters a controlled demolition sequence and just plummets. When the market turns against a highly leveraged, unhedged position, the destruction isn't a slow leak, it is a violent, unforgiving wipeout. The tragedy here is how quickly the illusion fades into dark comedy. Alex goes from viewing himself as the next Wall Street titan to becoming a literal internet punchline. His catastrophic losses end up as a screenshot on the Wall Street Bets forum, immortalized by a user pointing out that bro turned $80K into a large Domino's pizza. Meanwhile, back at that quiet kitchen table, his wife is suddenly typing a brand new favorite internet search: how to divorce someone who calls himself a market wizard. When the money is gone and the strategy of hope completely fails, the darkest defense mechanisms kick in: dodging responsibility. Alex refuses to admit he miscalculated the risk. Instead, he plays the blame game. Suddenly, the market is manipulated. The Fed is corrupt. He shifts the blame to politicians, like Joe Biden. He genuinely believes that institutional market makers, literally billionaires, are abandoning their day jobs solely to personally hunt down his specific stop-loss orders. Pointing the finger at external forces is just the easiest way to avoid facing your own terrible decisions.
So the crucial point is, it all leads us to realize this powerful macroeconomic truth together. Everybody is a genius when stocks only go up. When the market is roaring and every single chart is green, making money isn't a testament to your brilliant skill, it's just the macroeconomic wind at your back. Unearned luck in a bull market is constantly mistaken for genuine talent. But the second that wind stops, inexperienced traders get wiped out, completely shocked that their perceived genius suddenly stopped working.
Which leaves us with this final, vital question to think about. When reality hits your portfolio, whose fault is it really? You know, you can blame the central bank, you can blame politicians, you can blame bad luck. But at the end of the day, the person who sat at the keyboard, clicked the buy button, ignored the risk, and built a strategy entirely out of blind hope is the person staring back at you in the mirror. Let Alex's tragedy be your ultimate lesson. Take absolute personal accountability for your decisions, respect the raw power of the market, and never, ever stop learning. Thanks for joining me for this explainer, and I'll catch you next time.